Welcome to Macro Bites with EY Parthenon Chief Economist Greg Dacco. In this episode, Greg is joined by EY Parthenon America's Technology, Media, and Telecommunications leader, Melinda Gentry.
We're going to be discussing disruptions to the tech sector and how to continue driving unique growth strategies. I think one of the interesting developments over the course of the last few weeks is that we've seen a tremendous degree of policy uncertainty. We've seen tremendous financial market volatility, and we have an environment where a lot of business leaders are uncertain as to how to drive growth. In fact, in the recent EY CEO survey, we found that 41% of tech executives saw macro, trade, and geopolitical risks as their number one concern. How are you perceiving this narrative from your vantage point?
It's cyclical headwinds and structural policy volatility. What is going on with tariffs, the increase in tariffs, and the unpredictability around the tariff policy really is leading our technology companies and technology clients to, potentially stop, delay, reroute capital and making strategic investments. When you look at the market more broadly and the macroeconomic, are you seeing that drag on the U.S. economy as well?
We're absolutely seeing it. And that's the number one conversation that we're having with a lot of business leaders across multiple sectors. Tariff is the number one topic, but it's also the topic where there is a lot of uncertainty as to what the next steps will be. We've seen the average tariff rate in the U.S. rise from 2.5% at the end of 2024 to about 14% today, which is a massive increase in the cost of doing trade around the world. So from your vantage point in the tech sector, how are you seeing tariffs affect economic activity?
There's been significant impact in the tech sector. In a recent survey, EY Parthenon survey, over 53% of our tech executives cited tariffs as a reason for delayed, postponed capital allocation decisions. We are seeing a pretty significant impact in tech, largely driven through those very embedded supply chains into mainland China, Taiwan, and South Korea. Add to that the closing of the loophole of the de minimis exception, and you see consumer products and consumer goods and devices under extreme cost pressure. And that's really impacting, margin and competitiveness. What are you seeing from a macro point of view?
Well, I think we're seeing the same because we have in today's environment a globally interconnected web of trade exchanges around the world. It's not about two countries or two economies trading with one another. It's really about a supply chain that has a web throughout the world. And so these tariffs, these trade policy developments are essentially affecting businesses throughout the world and across sectors. CapEx decisions are being delayed or postponed, and we're seeing increased inflationary pressures that are reducing essentially the appetite to invest. Is that something that you're seeing in the tech space in terms of delays for CapEx?
Absolutely. I think our technology clients are reacting really tactically and practically right now. So we are seeing some delayed investments, right? We are also seeing the beginning of strategic pivots. So as opposed to being focused on traditional M&A for growth, we are seeing our technology clients and firms look at partnerships, alternative levers for organic growth, right, via venture building, and even at times minority investments. Those traditional M&A activities and the deal volumes we have historically seen, we've seen a lot of delay there due to regulation and things like that. And so that's where they've been challenged to really drive the growth. Now, I know you just updated the EY Parthenon Deal Barometer for 2025. What is it saying about deal volumes and activity?
Well, it's essentially a mirror image of what you just described. We have many business leaders that are on the fence when it comes to making decisions as to potential M&A activity or even private equity funds in terms of investing. We're not expecting any growth. That does not mean that there's going to be a massive pullback in terms of M&A activity, but it means that businesses are going to be cautious when it comes to making those decisions, and that's likely to leave overall corporate M&A and PE activity essentially unchanged relative to last year. But I think one of the interesting dimensions that we tend to forget is that there can be more of a pro-business environment coming from tax policy developments, deregulation, and those can actually drive stronger activity. Are you hopeful about these potential developments driving stronger activity in the tech space?
Many technology leaders and technology clients expected a much more predictable landscape under the current administration, and that's not what we've gotten. We've seen a lot of volatility with that. So with that, right? AI partnerships, algorithmic pricing, software licensing is all under a microscope. However, we have seen many of our technology firms still respond with agility, looking for areas to drive growth, changing operations, nearshoring supply chains.
And that's really what we're seeing across different sectors, because we've seen this pro-cyclical, strong productivity environment come out of the US. And this is not just a factor of technology. I think it's a factor of having longer tenured employees that are better trained and more efficient at doing their job. We also have seen more focus on driving a higher return on investment, given the high interest rate environment.
Are you expecting a recession, Greg?
We're not expecting a recession, but we are seeing that this heightened level of uncertainty, this potential reacceleration of inflation, and questions as to elevated interest rates are constraining business activity, are constraining economic activity, and therefore there are uncertainties as to how the economy will evolve over the coming months. So how are we advising tech executives to navigate this uncertainty?
Well, I'm telling our tech executives that balance is key. Now is the time to still remain focused on innovation and growth, but paired with cost discipline and strategic flexibility. It's not the time to retreat, but to adapt smartly.
Thank you very much for your insights, Melinda.
Greg, great to be here. Thank you for having me.